Was UBS's star trader, but Kweku Adeboli is tonight beginning a 7-year prison sentence after being found guilty of Britain's biggest ever city fraud. The rogue trader ran up losses of...
I am truly honored and truly excited to lead our companies forward in the 21st.
Where everything was the front of a building.
What if I told you that some of the richest, most respected people in finance were not heroes, but master deceivers? People who rewrote the rules, broke trust on a global scale, and left thousands ruined. In the next 20 minutes, you'll hear the stories of 8 financial criminals whose greed wasn't just big, it was historic. These are not just cautionary tales, they're reminders that power plus money plus dishonesty equals disaster. So buckle up, because this is going to be wild. Here are 8 of the most notorious financial criminals in history. Their crimes, how they got away for so long, and how they were finally exposed. 1. Bernard "Bernie" Madoff. What he did: operated the largest Ponzi scheme in modern history. He promised steady, often modest returns, fooled investors for decades, while in reality paying old clients with new clients' money. Scale: loss estimates vary, but tens of billions of dollars. His scheme was about $64.8 billion in statements when it collapsed in 2008. How he got away so long? Reputation: he was a well-connected Wall Street figure, seen as respectable. Complexity and secrecy: he used feeder funds, offshore entities, trusted middlemen. Regulatory failures: warnings were ignored. His consistent returns, even in down markets, should have raised red flags. How he was caught? Consequences: collapse of markets in 2008 triggered mass redemption requests. He couldn't keep up. Pleaded guilty in 2009 to 11 federal crimes. Sentenced to 150 years in prison. Died in prison in 2021. Why it matters: massive harm to ordinary people, retirees, charities, small investors. Also changed regulatory scrutiny, blender of trust versus skepticism. 2. R. Allen Stanford. What he did: orchestrated a $7 billion Ponzi scheme using his bank, Stanford International Bank, Antigua, to sell high-yield certificates of deposit, CDs, to investors, promising safe returns, while using new deposits to pay earlier investors and to fund lavish personal luxuries. Scale and reach: tens of thousands of investors, 30,000 plus, across many countries. CDs owed by his bank by 2008 over $8 billion. Key tricks and deceit: and fabricated documents, false financial statements, used new CD sales to pay off older redemptions. Classic Ponzi mechanic. Inflated real estate values. For example, one property bought for approximately $63.5 million was later on paper valued at 5,000% more, i.e. over $3 billion, to create illusion of backing assets. Bribed local regulators and auditors in Antigua to look the other way. Outcome: convicted in 2012, sentenced to 110 years in prison, ordered to forfeit billions. Most victims never fully recovered their money. 3. WorldCom/Bernard Ebbers. What he did: manipulated accounting to inflate profits massively, capitalizing costs, which should have been immediate expenses, hiding line items, etc. Essentially cooking the books to keep stock price and investor confidence high. Scale: they overstated assets by over $11 billion. Why it lasted: many layers. Senior management, auditors, analysts, even outside observers were fooled. Weak internal controls. The complexity of telecoms and costs made it easier to hide things. Fear of market reaction also played a role. Exposure and consequences. Internal audit: Cynthia Cooper and team raised alarm. SEC investigations. Bankruptcy: CEO Bernard Ebbers convicted and sentenced, 25 years, later reduced for health. Massive fallout for investors and employees. 4. Enron. Kenneth Lay, Jeffrey Skilling et al. What they did: used complex structures, special purpose entities, to hide debt, inflate profits, pretend that failing ventures were profitable. Essentially fraudulent accounting and mass deception of shareholders, employees, regulators. Key techniques: off-balance sheet entities that kept debt and liabilities hidden. Mark-to-market accounting misused, booking future projected profits immediately. Aggressive, opaque financial statements. Huge energy trading operations, some of them shaky. How they fooled people: Enron was once considered innovative, an energy trader, into broadband, etc. Big reputation, high growth narrative. Auditors and analysts were complicit or misled. Many employees invested their retirement in company stock. Collapse and aftermath: exposed in 2001. Bankruptcy: Kenneth Lay and Jeffrey Skilling convicted of fraud, conspiracy, etc. Arthur Andersen, their auditor, collapsed as a firm. Reforms followed, for example Sarbanes-Oxley Act, to increase transparency. 5. Charles Ponzi. Why he's famous? He gave his name to the Ponzi scheme. He didn't invent the idea, but his scheme in 1919 to 1920 in Boston became the model for all future versions. What he promised versus reality? He claimed he could make huge profits by arbitraging postal reply coupons across countries, buying cheap abroad, redeeming high in the US, promised 50% profit in 45 days or 100% in 90 days. In reality, there was little legitimate arbitrage. The scheme was sustained by paying early investors from funds raised from later ones. Collapse. The scheme ran about a year, collapsed when redemptions exceeded new money, media scrutiny. The losses, in nominal dollars back then, were huge for the time. Legacy. The term Ponzi scheme is now universal. His story remains a direct illustration of too good to be true deception. 6. Theranos. Elizabeth Holmes and Sunny Balwani. What they claimed. Theranos said they had invented a breakthrough technology that could run dozens of medical tests using just a single drop of blood. Promised faster, cheaper, easier diagnostics. How the fraud worked. The technology didn't work reliably. They misled investors, partners, the public. They submitted false test data, exaggerations, hiding test failures. Scale and impact. At its height, valued at approximately $10 billion. Investors included prominent people, but patients were endangered. Medical data was inaccurate. The fallout was dramatic when whistleblowers and investigations exposed the lies. Outcome: Holmes and Balwani found guilty, fraud and conspiracy. Sentenced to long prison terms. Massive financial loss for investors. Also, a moral impact. When health meets deception, stakes are higher. 7. Kweku Adoboli. What he did: a trader at UBS's London office engaged in unauthorized trading, hiding risky positions, entering false information, ignoring bank limits. His trades led to massive losses for his bank. Scale. The loss reported was about $2 billion at UBS. Market cap and share price of UBS took a huge hit. How he got away for a while. Trading desks can be complex. He hid trades using back-office functions. Also, oversight was lacking. Risk management failed to spot and stop him earlier. Aftermath. Arrested in 2011. Convicted, sentenced. His case is often cited in discussions of rogue traders and the need for better risk controls in big banks. 8. Others and honorable mentions. I want to mention a few more, because narrowing to exactly 8 means leaving out some wild stories. But these show how varied financial crime can be. Ernest Terah Hooley, England, late 19th, early 20th century. Property promoter, repeatedly inflated values, defrauded investors, declared bankrupt multiple times, jailed for fraud. Emmanuel Nwood, Nigeria, defrauded a Brazilian bank of $242 million under the pretense of building a fictitious airport. Victor Lustig, more of a con artist than corporate criminal, but his scams, including selling the Eiffel Tower, are legendary. Common patterns. Why these crimes took place and why they worked. When you look closely at all these financial scandals, you start noticing something fascinating and terrifying. These weren't random accidents or one-off mistakes. They followed patterns. First, trust and reputation played a massive role. Many of these criminals weren't outsiders lurking in the shadows. They were respected insiders. Bernie Madoff was practically Wall Street royalty. Enron was once the darling of corporate America. When someone seems too important, too respected, too established, people hesitate to question them. That reputation becomes a shield, and behind it, deception thrives. Then there's complexity and secrecy. The more complicated the business model, the financial instruments, or the accounting structures, the easier it becomes to hide wrongdoing. Offshore accounts, shell companies, special purpose vehicles. These layers aren't just confusing, they're perfect smokescreens for fraud. Ordinary investors and even regulators often have no idea what's really going on. Another major factor? The promise of high returns with low risk. Human nature kicks in here. We all want good results with little danger. So when someone offers sky-high profits with almost zero risk, we want to believe it. That hope blinds even experienced investors to obvious red flags. And of course, weak oversight plays its part. Regulators miss things. Auditors get too cozy with clients or fail to dig deep enough. Internal compliance teams are underfunded or overruled by executives chasing growth. When nobody's watching closely, bad actors flourish. Finally, there's a cocktail of greed and fear. Greed drives people to pour in more money. Fear of missing out pushes them to ignore doubts because everyone else is making money. Why shouldn't I? It creates the perfect storm where whistleblowers are silenced, critics are ridiculed, and fraudsters buy more time to keep the scheme alive. All of these elements combine into a dangerous cycle. Trust shields the fraud, complexity hides it, greed fuels it, oversight fails to stop it, and by the time reality hits, it's too late for most victims. Lessons and takeaways. We can draw lessons, not just horror stories. Always question investment promises that seem too good to be true. High returns plus low risk almost always equals red flag. Diversify, Don't put everything with one person/company. Do your homework. Check whether returns are plausible. Check regulatory filings. See whether there are outside auditors, whether reports are consistent. Watch for insider issues, management conflicts, lack of transparency, opaque financials. Regulation and oversight need to be strong. History shows many disasters came when oversight failed. Lessons we can't ignore. Every one of these scandals teaches us something important, something that goes beyond finance and numbers. The first lesson is skepticism. It's not about being cynical, it's about being smart. When someone promises you the moon, high returns, no risk, guaranteed success, remember this: if it sounds too good to be true, it probably is. That one thought could have saved billions of dollars and countless lives from financial ruin. The second lesson? Never fall for the cult of personality. Madoff, Enron's executives, Elizabeth Holmes, they all had charisma, confidence, even charm. But charisma is not proof. Blind trust in authority figures often blinds us to reality, the human cost behind the numbers. We often talk about financial crimes in billions and trillions, but behind every dollar lost is a person. Retirees who lost life savings, families forced out of homes, employees whose entire careers collapsed overnight. The human cost is immeasurable. Think about Enron employees who invested their entire retirement funds in company stock, only to watch it become worthless. Or Madoff's victims, some of whom had to come out of retirement to work again. These crimes weren't victimless, they shattered real lives. Why we keep falling for it? You'd think after Ponzi, after Enron, after WorldCom, people would learn. Yet new scams keep popping up. Why? Because human psychology doesn't change overnight. Greed, fear, and the desire for easy wealth are powerful forces. Fraudsters exploit these emotions masterfully. And let's be honest, technology makes it even easier now. Cryptocurrency scams, fake online investments, deep fakes, the tools of deception keep evolving. But the playbook? It's the same one Charles Ponzi used a century ago. A final thought before we wrap up. Here's the truth. Financial crimes will never fully disappear, but awareness is our best defense. The more we understand these patterns, the harder it becomes for criminals to exploit them. And that's why these stories matter. Not to scare you, but to prepare you. And remember this, financial crime isn't just about money, it's about trust. When trust is broken, the damage spreads far beyond bank accounts. It shakes entire economies, ruins reputations, and sometimes even changes laws. That's why learning these stories isn't optional. It's essential for everyone. These 8 criminals weren't born evil. They made choices. They gambled with trust, took shortcuts, and for a time, they won. But in the end, trust is fragile, and the truth catches up. You, the investor, the watcher, the learner, you are the force that puts pressure on the system. If you found even one of these stories shocking, inspiring, or making you doubt what you thought you knew, that's good. Because curiosity, skepticism, and the courage to ask questions are what prevent the next financial monster from growing in silence. Subscribe for more deep dives into financial history, the good, the bad, and the lessons we need. Share this video so others can see there's so much to learn from the past, and so much power in knowing. Don't let someone else pay for what we could prevent. Knowledge is the first shield against financial deception everywhere.